after another good day for the averages. In the wake of some encouraging inflation news, this time it was a cooler than expected producer price index number. We got to ask ourselves if this market's changed its stripes. You know, that's my theme for most of this year. Chasing big rallies was a gigantic mistake. Just when you thought things were getting better, boom, the Federal Reserve would raise interest rates again and give you some grim commentary about the need for even more tightenings. But man, this market's not trading like that anymore, is it? At least for the moment. Now that it looks like inflation is peaking, that means the Fed can afford to be a little less ruthless, which would be great news for the stock market. Of course, the problem with this thesis is that we've been there before when commodity prices. Remember when the prices peaked over the summer? I know I was leading that band charge, leading some to assume that the Fed would declare victory in the fight against inflation, only for Jay Powell to crush our hopes all over again in August, as he didn't think that commodity inflation was important as wage inflation. Now, this makes this a tricky moment, especially because the hottest stocks on a day like today are the tech names, the ones I have the least confidence in, frankly. But when the market's tough to fathom, I like to take my emotions out of the equation and fall back on technical analysis, TA, because it gives us a more empirical way to approach the market, unemotional. And that's why tonight we're going off the charts with the help of Jessica Inskip. She's a genius technician. She was the first woman on the active trader desk at Fidelity before becoming the director of advanced trader strategy at Merrill Self-Direct. Now she's the director of product and education at OptionsPlay, but she still consults with all the major brokerage firms in the self-directed space. Plus, you can see her every Tuesday on Fidelity's weekly options trading show, In the Money. Now, I got to tell you, Inskip's feeling pretty good about this market. Now, some of that's because we've got a powerful seasonal pattern on our side. We talk about this every year. As we get into late November, we tend to have a powerful Santa Claus rally through the holidays. Just as important from Inskip's perspective, we don't need to worry about any major macroeconomic catalyst to the middle of next month when we get the next consumer price index reading and, of course, the next Fed meeting. Even if Jay Powell decides not to ease up on the rate hikes, we're not going to know about it for weeks, which means the averages are free to romp in the meantime, and that's what they've done historically. Now, on top of that, Inskip likes what she's seeing in the options data. I don't want to get into too much detail here, but she's got her own proprietary system to figure out the directional bias of the averages based on options volume and the concentration of those options contracts. What she finds is that when we're looking at the S&P 500 contracts for November, December, and January, things look not so hot for November, but those options expire in a few days. Once we're in December, her methodology says things get a lot more bullish before cooling off a bit in January. The S&P is pretty diversified, though. What about something more tech-heavy like the NASDAQ 100? These stocks have been roaring in recent weeks, but Inskip's system suggests that things look less bullish in December before they turn around pretty down bearish in January. And I've seen that before. January tech sell-offs are legendary. Based on the options data, the S&P is staying power. But the NASDAQ 100 might only get a brief Santa Claus pop. Remember, I told you technology is the biggest part of this market. On the other hand, the Russell 2000 small cap index has a very bullish directional bias. All of this supports a broad-based rally at least through December 16th, which is December options expiration day. From mid-December through mid-January, Inskip expects things to get a little more complicated. But let's just deal with reality right now. Let's dig deeper. Take a look at the daily chart of the S&P 500. Inskip points out that when the S&P was making lower lows in late September and early October, we caught what is known as a bullish divergence. That's the yellow signs here. Specifically, the relative strength index, that's the RSI, okay, and the moving average convergence divergence, or the MACD line, started gaining strength at the same time, right? And these are two important momentum indicators, and their upturn predicts, all right? They're not coincident. They predicted the market's rally. Then late last month, the S&P broke through the ceiling of resistance at 3,800, which is, you want to look at here. This is the resistance line, okay? Broke through it. Now the ceiling has become a floor of support running from 3740 to 3810, and that's that 3810 right there. Okay, so now it's down about 200 points from where it's currently trading. Just today, though, the S&P broke out above a key Fibonacci level. We had a ceiling at 3998. I was talking about that with Carl this morning when we were on Squawk on the Streets. And because it represented a 38.2% retracement of the prior move, that's positive. Now, Inskip thinks the next stop could be the 200-day moving average, which is currently 4078, and you would really want to be long for this one. The S&P couldn't break past that level at the peak in August, okay, all the way back it failed. Maybe this time will be different now that inflation finally seems to be going in the right direction. The August one was that fake out by just the actual raw commodities, not wage inflation. Now, okay, so let's now switch to the NASDAQ 100. Now, tech let us down all year. Remember, it peaked in November of last year, and in recent weeks, it's been leading us back up ever so slowly. Of course, this would also be the first group to implode the moment the Fed starts talking tough about big rate hikes again. Inskip points out that the NASDAQ 100 is still in the process of clearing the ceiling resistance that runs from 11,600 to 11,841. There's your ceiling resistance right here, and you can see it's having very, very tough time trying to breach that. It broke out above that level during the day today, and if it can stay up there, Inskip says to expect a stronger rally. So today, she thinks was a crucial day. I'm not so sure, but I like the idea here. Remember, her option analysis says the next 4 weeks could be very good for everything, including tech. So if we get a down opening tomorrow, maybe that's a chance. Finally, now look at this one. This is a daily chart of the Russell 2000 Small Cap Index. We care about the Russell because we like a market with good breadth. We're not going to have a sustainable rally here unless we're seeing strength across the board. A couple of weeks ago, the Russell 2000 broke out above its ceiling of resistance. This is a very important zone of 1,800. And again, you can see it's got to go straight through and then boom, right through that level. Very positive. Plus, the index didn't actually make a lower low last month, although it came pretty close. That's an encouraging sign. Now, it's trying to break out above its new ceiling of resistance at the 1,900 level. That's this gray line. Which it did at one point today. Inskip says that if the Russell 2000 can stay here above its 200-day moving average, well, she expects more strength. So we're obviously at a very pivotal level for this one. I think the S&P is better than NASDAQ and then this one. Here's the bottom line. The chart, as interpreted by Jessica Inskip, suggests that this rally could potentially have real legs, at least through mid-December. Things could change as we get closer to the next Fed meeting a month from today. But in the meantime, there's a lot to like about this market. And my commentary is to say that we are at crucial levels, but that I am biased toward the long side between here and year-end. Fed money is back after the break.
Coming up, Cramer wants to hear from you. Your calls on the thunderous lightning round. Next.